accounts, right?
Yeah.
Is lending, all right? Or, sorry, borrowing. I mean, they want to borrow money, right?
Yeah.
That's the most, it's like I need some money to buy whatever, tractor or new phone, motorbike. How do I do this? You borrow money. And if you can't borrow from your friends or family, you have to go to some sort of financial institution. Typically, it's a microfinance institution or a bank, and these are centralized. Now, with decentralized finance, borrowing and lending money is one of the core parts of decentralized finance. It's the core sort of backbone product of DeFi. And the difference here is that if you wanted to borrow money on a decentralized network, at least the ones I know, you don't need to show your identification like you do with a decentralized finance network, because you just use your accounts, so you don't need to go through what they call KYC, know your customer, or eKYC, but you might think, well, okay, that's good. It kind of keeps things simple. It keeps things anonymous. It protects privacy. Perhaps you don't want people to know that you're borrowing money for something, for a motor or whatever. The other thing is that you can borrow money with collateral, and usually on a centralized system, the collateral is another sort of physical product. It's usually land, land title, or I've never borrowed money from a microfinance, so I'm not really sure exactly what they use for collateral. But it could be land.
It could be land. It could be other things that is physical product that it has value. They're putting on into it.
And so for a decentralized lending platform, it's more crypto basically, and usually what they ask for is over collateralization, meaning that if, like, say for example, 200% over collateralized loan means that if you want to borrow $50, you need to put up $100 in another currency, in another crypto, and so this is just a protective measure against against the default on the loan, and also it just helps to protect the ecosystem. So of course, with a bank, if you default on your loan with a bank, they will take your land. In the crypto decentralized finance world, typically it's a liquidation event, of your loan. So of the collateral, I should say, that you put up for the loan. And that's it. And the other thing is that happens very quickly, much quicker than a centralized system. So like a microfinance is pretty quick. A bank is a lot slower. But crypto decentralized finance is instant. As long as you've got a working account with your private keys and with a wallet and with the collateral that's required for the loan, you'll get the loan guaranteed, as long as there's liquidity.
Cool. For it. I think there's one more thing when you talk about the KYC free. There's one more thing, because this is so general. When everyone wanna get a loan from a microfinance or any financial institution, they will have to go for a credit score checking the history of this guy lending before or borrowing from other institution, and how he pay back to the lender.
That's right.
So and also, when you talk about how we're going to deposit from the physical valuable in terms of the collateral, and then when it comes to decentralized, when we talk about the cryptocurrency, we'll use the cryptocurrency and take a loan in the cryptocurrency. I'm still curious about why still people borrowing in the cryptocurrency and put the cryptocurrency as a collateral.
Oh yeah. Well, it does seem at first a little bit strange, right? Because and the real reason is because it's just an asset swap essentially. So if you think about borrowing again, come back to centralized finance and real sort of assets. If you've got some land, you're essentially saying, here's my land. Here's the title to my land. Here's my land, and if I don't, but I want to exchange that asset for some money, but I don't want, but I want to get that land back after I pay back the asset.
Yeah.
And so essentially, what you've done there is you've just swapped something. You've done a swap. And that's essentially what's happening a lot on DeFi. Is that, and you'll hear the word a lot, especially like Uniswap, is where it happens. But all of the DeFi protocols essentially have swaps, and you're swapping one for another. You're swapping one asset for another asset. Now, why do you do that? Well, it's because it's because, like in the case again back centralized finance, it's because $1,000 is going to get you your motorbike, but your deed title won't, right?
Yeah.
Well, it might do, but it's not a good exchange, right? Because you think about your land price goes up.
Yeah.
You want to keep holding your land. You don't want to sell your land just for a motorbike.
Yeah.
But you still want a motorbike. So how do you borrow money, right? And how do you borrow money that's safe for the institution lending you the money? They need collateral, right? So it's equal or more value to what you're borrowing. Usually. Yeah. And so in the case of crypto. Why do you swap crypto for crypto? Because the crypto you're swapping your original crypto for is worth more. Is one example. Is one simple example. But if we probably we'll talk about yield farming in a bit. But basically another reason for doing that, of course, is to get liquidity. Governance tokens or liquidity pool tokens, or this kind of thing, where you get actually rewarded for borrowing or lending money from a liquidity pool through another token, which is unheard of in the centralized world, right? I mean, it's almost like the bank saying, if you borrow from us, we will give you money. We'll give you more money.
Still, it's just like a customer reward based on the lending protocol. Like if you are part of the lender or a borrower, you still get rewarded with other token.
Still
equal to some money.
The key point is that it's a different token, right?
Yeah.
So obviously, the asset class or the token that you're borrowing has an interest rate, just like here. So if you borrow dollars, you have an interest rate. You pay that interest in dollars. But on crypto world, you pay that interest in whatever the crypto is you're borrowing.
Yep.
But you also get another token, which in some cases recently, like with for example compound, comp and the comp token, it was actually you would actually end up making more money than the actual interest rate payments on the principal amount that you borrow, with the value of the comp token, if you get what I mean.